Welcome to Dr. Fred Markets. This is not financial advice. Every day, billions of dollars move across markets that most people don't even know exist. Crypto, stocks, AI, the signals are there if you know where to look. And that's exactly what we do here. Let's dive in.
Trillionaires are a distraction. The real money hides in your boring bond fund. Elon just became the first trillionaire on paper as SpaceX rips higher, and the S&P 500 creeps up to 741 with a calm 0.54%. Meanwhile, your sleepy bond and money market funds now throw off 5% plus yields, and Wall Street quietly financed a $40+ billion media monster. The DOJ just greenlit Paramount, swallowing Warner Bros. Discovery. And while everyone doom scrolls wars and elections, private credit funds lend at 10 to 14% to the same corporations your index fund worships, skimming fat interest streams you never see. Here's the pattern. Capital left the casino floor and moved into the vault. The fund stocks trend on CNBC, but the real cash flow sits in fixed income land and private credit, rented out to the same corporations, pushing your favorite shows, rockets, and political theater. Let's start with the fake excitement. Elon the trillionaire. SpaceX finally hits the public markets, valuations go orbital, financial media has a new king to worship. Awesome story. For them. For you? You get access at the most expensive moment after a decade when early investors harvested the 100x. The math is simple. Every new buyer of a hyped IPO is paying a dream tax. Most of that tax turns into steady, boring interest payments to creditors. Signal 2. The DOJ blessing Paramount's takeover of Warner Bros. Discovery. Everyone argues about content wars, Marvel vs. DC, streaming bundles. That noise hides the real game. These monsters are debt machines. Media conglomerates gorge on cheap debt when rates are low, then refinance at uglier terms when rates jump. The winners are not the bag holders of stock chasing synergies. The winners are the creditors getting paid before everyone else, with covenants, collateral, and priority in bankruptcy. Signal 3. The quiet renaissance of yield. For a decade, yield was a joke. Savings paid 0.01%. You were blackmailed into buying risk assets. Now short-term treasuries hover near 5%. Investment-grade corporate bonds yield 5 to 7%. Private credit funds lend at 10 to 14%. That's not grandma's CD era. That's Wall Street insiders lock in double-digit, contractually enforced cash flow, while your attention is on rocket emojis and election drama. So you've got a trillionaire mascot selling the dream of infinite upside, a mega media merger financed on the back of corporate debt, yields high enough that quiet money no longer needs hero moves. Here's the connection nobody wants to say out loud. The era of free money is dead, and the new power seat in markets is not the flashy equity trader. It's the creditor, the lender, the boring bastard who gets paid first. Media conglomerates, rocket companies, data centers, whoever, they all tap the same well, debt markets.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
When money was free, equity bros ruled because leverage was cheap and margins were fat. Now, every percentage point of interest hits earnings like a hammer. That hammer belongs to the people who own the loans and bonds. And private credit? That's just lending without the public ticker symbol. Pension funds, insurance companies, family offices, they're stuffing cash into private loans yielding mid-teens, while you argue on Reddit about whether the S&P is in a bubble. The memes are public, the real yield is private. Here's the one thing you learned today. In a higher rate world, owning the debt is often a better business than owning the story. Trillionaires are proof of how valuable the story is. Debt holders are proof of who actually gets paid. Mechanism time, in plain language. When a company like Mega Media Corp merges and restructures, they refinance old loans, issue new bonds, and negotiate interest coverage. Equity gets dividends if there's anything left. Debt gets coupons on a schedule with legal teeth. If ad revenue drops or streaming subscribers bail, guess who still gets paid first? Not the guy cheering the ticker, the lender. Same with SpaceX-style growth darlings. Rockets burn cash. That cash is either equity dilution or debt. As rates stay high, cheap growth becomes expensive, and companies start crawling to creditors, begging for better terms. Creditors decide who survives. Equity holders just watch the chart. What do you actually do with this? Again, not financial advice. But here's the truth. 1. Learn to read yield, not just price. Stop staring only at S&P and Nvidia ticks. Start tracking 2-year treasuries, corporate bond yields, and credit spreads. When yields are juicy, someone is getting paid a lot to take that risk. Ask why it isn't you. 2. Add one credit sleeve to your mental portfolio. That can be as basic as a short-term treasury ETF or an investment-grade bond fund, or as advanced as researching listed business development companies, BDCs, or public-private credit ETFs. You don't have to ape in. You need to understand how getting paid first feels. 3. Whenever you see a mega merger headline, ask, who lent them the money? Track the bonds, not just the stock. Look at debt levels, interest expense, and maturities. That's where future pain or profit lives. Equity is just the gossip on top. Stop worshiping the Trillionaire scoreboard. Start acting like the house, not the drunk gambler. This is not financial advice. But in 2024's market, choosing to stay only in equities while yields are screaming is not conservative. It's negligence. Subscribe, come back tomorrow, and we'll keep following the money away from the noise straight into the vault. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.